Hey, Rich Hillo, Straightforward Wealth Management. How you doing today? It's been a day. I grabbed an adult beverage. Why don't you grab one? Maybe a cup of coffee. I want to talk to you today about annuities. In times of struggle and strife in the market, it's down, people get scared, annuities come up, advertisements come out. I have clients that come in and they'll show me this annuity or that annuity and how come it's good or bad or indifferent. Annuities are really complex animals, so I'm just going to give you kind of a 30,000 foot view of what an annuity is. And if you want a longer conversation, we can chat a little more about specifics. There's 2.5 types of annuities. You've got your fixed annuity, you've got your variable annuity, and the half is kind of the fixed indexed annuity, which is kind of a hybrid, gives you a little bit of both. You know what a certificate of deposit is, right? A CD at the bank, 3, 6, 9 months a year, sometimes up to 5 years. Well, a fixed annuity is like a CD on steroids, where the CD is guaranteed by the FDIC, a big government-backed agency. The fixed annuity is only guaranteed by the insurance company, so it's the strength of the insurance company. So where a CD rate may be 0.5%, 0.75%, an annuity rate will be 2.5%, because there's more risk involved. It's just the insurance company, not the government. But it's basically a CD on steroids, as I said. Instead of being 3 or 6 months, they start at 3 years. 3, 5, 7, 10. I've seen them as long as 20. But you're guaranteed to get that interest rate, 2%, 3%, whatever it happens to be, for that amount of time. Sometimes it's simple interest, so you put your $100,000 in, you get 2%, $2,000 every year. Sometimes it's compounded depending on the contract, depending on the company. But that's a fixed annuity. It's a small interest rate guaranteed by the insurance company for a certain length of time. In this case, and in any annuity, there are typically surrenders involved. In a CD, you get a 6-month CD. If you take it out before 6 months, you pay a month worth of interest in a surrender penalty. With annuities, it's much more significant. It can be 3, 4, 5, 6, 7, 8, 10%. If you take it out in the first year and it drops off, the longer you keep it. The insurance company wants to make sure that they make their money. So, just be aware as we're talking about this that there are those penalties involved as well. The variable annuity is just like it sounds. This has no guarantee. It's invested in the market. It just has other riders that go along with it that allow you to do some things like maybe pensions. It has a good tax deferral, as all annuities do. You do not pay taxes as the value increases. You get taxed when you pull it out. Again, a conversation to have with your tax preparer. I am not, to see if the tax deferral will work for you. But the variable side, it's invested in the market just like you would invest in an IRA or an investment account. It just has an umbrella over the top that gives you some guarantees. The hybrid, the fixed indexed annuity, you put money in, $100,000 in, say, you will never lose a penny of that, of course, as long as the insurance company is around. If the market goes up, an index such as the S&P 500, that index goes up, you're capped at how much you can make, 4%, 4.5%, I've seen them as high as 5%. The market goes up 20%, you get 4. The market goes up 10%, you get 4. Market goes up 2%, you get 2, so it's up to that 4%. But if the market drops 20%, you don't lose a penny. You don't make anything, but you haven't lost anything. So it's kind of that good middle ground. Those are the kind of 2.5, 3 types of annuities that are out there. Are they appropriate for you? I don't know. We'd have to have a conversation about that. A conversation with your tax preparer. A conversation about what you have in retirement, what you want to do for this money, that kind of thing. Because a 7-year annuity, there's a surrender for 7 years. Every year you have that annuity. 8, 7, 7, 6, 6, 5, 5, 4%, and then 0. So it's a significant decision to make because you're essentially locking up that money because it's such a huge surrender. So when you're having this annuity conversation, have it with somebody that understands what they are, because they can be really confusing. It's an hour conversation I have with a client when I'm talking about annuities to make sure that they understand the upside and the downside, and to make sure it is truly appropriate for them. Well, I hope that helped you a little bit, clarify kind of the difference in annuities, understanding a little more. Until next time, cheers.